In this video tutorial, we'll go over 3 options strategies that every derivatives trader should know. We'll be using Lyra to trade options and show you how to hedge against market risk when opening a position using perpetual contracts on Perp v2. Our blog post outlining these 3 strategies is linked in the description below. You can also check out Lyra's article on the differences between crypto options and perpetuals to learn more about the pros and cons of each. This tutorial will show you how to execute 3 strategies to hedge against market risk: the protective put, the protective call, and the covered put. Let's look at the first strategy, the protective put. The protective put strategy is where you are long, but you simultaneously purchase a put option to protect your perpetual position from losses in the event that the market price falls below your entry price. Here we can see the payoff diagram for a protective put, compared to the case where you just have long exposure. If the price falls, then the put option will be in the money, reducing the losses from the long perpetual position. However, the flip side of this is that when the market goes up and the long position is profitable, the premium paid for the put option will eat into your profits. Now, let's illustrate this with an example. I'm going to long 1 ETH on Perp v2. After executing a position, take note of the entry price, as this will become important for determining which put option you're going to use to hedge against this position. So here we can see the average entry price is around $1,500. After opening the long position on Perp v2, we can head over to Lyra and purchase a put option for ETH using SUSD. We want to find the put option with a break even that is as close as possible to our entry price. So we're going to buy the $1,700 ETH put option, which has a break even that is closest to our entry price of $1,500. As shown by the expected profit loss chart, a $100 drop in ETH would give a profit of around $88 for one put option, while the P&L of the long perpetual position would be around -$100. While providing protection when the price falls, buying one put option comes with a hefty premium of $208. So if your trade idea works out as planned, we'd need to see a $200 rise in ETH to break even overall. To gain some protection, but at a lower cost, we can simply buy 0.5 put option contracts instead. It's up to you how much protection you want from buying a put, but just remember the trade-off. A put that gives full downside protection, where any losses from the long are balanced out by profits from the put, will cost more in premiums. It will also more aggressively eat into your profits if the market moves higher and your long position becomes profitable. So here you can see that I bought the put option using the SUSD stablecoin, and you have to confirm a transaction to allow Lyra to use your SUSD assets. Once confirmed, you can purchase the put option contracts. The second strategy is the protective call, which is where you are short using perpetual contracts and you simultaneously buy a call option to protect the short from losses in the event that the market price falls below your entry price. Here you can see the payoff diagram for a protective call, compared to the case where no call option is purchased and you just went short with naked exposure. Notice that if the price rises, then the call option will be in the money, reducing the losses from the short position. The flip side is that when the market goes down and the short position is profitable, the premium paid for the call option eats into these profits. Let's look at an example to make this strategy clearer. So here, I'm going to short 15 SOL on Perp v2 and take a note of the entry price. After the short position has been executed on Perp v2, we can head over to Lyra and purchase a call option for SOL. Again, we want to find the option where the break even is as close as possible to our entry price. So we're going to buy the $28 SOL call option, which has a break even that is closest to our entry price. We can buy 15 contracts for full protection, where the profits from the call option contracts will roughly equal the losses for the short position. However, we will have to pay more in premiums. Also, if the short position becomes profitable, then the purchase of these call options increases our overall break-even price. Instead, we can buy 7.5 call options to give us some protection when the price rises, while reducing the amount by which the premiums eat into our profits if the price of SOL falls. For the purchase of 7.5 call options, the premium paid is around $36. So our profit from the short SOL position will be reduced by this much if the trade idea goes to plan. So here we just click on buy a call and then confirm the transaction in our wallet. The third and final strategy you should know is the covered put, which is slightly different from the previous 2 examples, as instead of buying an option and paying a premium, we'll be selling an option to earn a premium. The covered put strategy involves going short using perpetual contracts and selling a put option. Here you can see the payoff diagram for a covered put, compared to the case where you just have a short open. The upside is capped in this strategy, but the profit is higher compared to a simple short position when the price is above the put option's strike price. Now, let's look at an example. In this case, I'm going to short $150 worth of Bitcoin on Perp v2 and take a note of the entry price. So in this example, our entry price is around $20,180. Now we can head over to Lyra to sell a put option for Bitcoin. We'll sell the 22,000 put option for Bitcoin. When the market price is greater than the strike price, the put option will expire out of the money and you'll earn the premium as a seller, absorbing any losses from the short position. However, if the put option expires in the money, then your profit is capped and you'd have been better off just shorting, although taking more risk. Here I'm selling a put for 0.00375 Bitcoin, which is equal to half the position size of the perpetuals position. So at any price above the strike price, you'll earn extra from the premiums received from selling the put, as compared to a simple short, absorbing some of the losses in case your idea doesn't work out. Now some final thoughts on these free options strategies. By executing these trading strategies, you avoid taking on any naked exposure, which can be risky and lead to losses, especially when prices are volatile. Even if the market moves against you, these strategies ensure that you can limit your losses in case your trade idea is wrong. It also gives you flexibility, as you can close the options trade if your trade idea is going to plan, or you can close the perpetual position once it becomes clear that the market is trending in the opposite direction to what you initially thought. So in summary, if you have short exposure using perpetuals, then you can use a protective call or covered put to protect your capital in case the underlying asset moons. On the other hand, if you have long exposure using perpetuals, then you can use a protective put to hedge against risk and protect your capital in case the price dumps. Thanks for watching, and we'll see you in another video tutorial soon. Happy trading, creating and market making.